Hi and welcome to this month's Trade Floor Update. My name is Brendan Rodder and today I'm joined by Portfolio Manager Aditya Thacker. Aditya, it's been an interesting week for markets to say the least. We've seen bond yields rise, which has caused some market volatility across both equities and fixed interest. Can you explain to our clients what has caused this rise in yields?
Yeah, sure. It has been a very volatile and unpleasant start for fixed income investors this year. We've seen the 10-year Australian government bond yield rise by about 70 basis points and the equivalent US 10-year yield rise by about 50 basis points. So when I think about what's causing this rise in yields, I come down to kind of three main factors. First and foremost, there's been a genuine improvement in the kind of macroeconomic conditions, activity, and also the outlook. So when we look across the world, we've seen a fall in COVID cases. That's enabling economies to ease restrictions and open up. And the economic data and recovery has been bouncing back at a faster pace than what the market generally expected, particularly in Q4 last year. So the current activity has definitely improved. On top of this, we now have the prospect of a second very large fiscal stimulus in the US in the order of $1.6 to $1.9 trillion. So when you take this in conjunction with the first fiscal package they passed late last year as well, we're talking something in the order of 10 to 15% of GDP as a fiscal boost to US growth for 2021 and 2022, which is just huge. So, these things are certainly strengthening investor confidence and their outlooks for 2021 and 22. And that's certainly that's been the main cause for the rise in yields. Now, factor number two, I would say, as an indirect consequence of this huge fiscal stimulus to come, there has been increasing debate about the risks of future inflation. We've even seen a few prominent progressive economists like Larry Summers and Olivier Blanchard come out and raise these concerns. So obviously with investors, if there's increased uncertainty, investors require additional compensation to take on that additional uncertainty. So we've seen an increase in inflation risk or inflation premia. And also you could say that there's greater uncertainty around issuance and supply of US treasuries, which will be required to fund the deficit spending. So this is what fixed income investors might call an increase in term premia. So there are the two factors. And the third factor I would say, which really explains the last part of the sell-off when things really accelerated last week, was really more a story about positioning, and particularly positioning being unwound by levered investors, the likes of hedge funds, bank trading desks, and momentum style investors as well. So when we kind of look at where we're at now, I think the first two factors are valid, and we won't see any kind of retracement in yields due to those two. But we have seen a little bit of retracement in yields once the positioning had come out of the market. So bond yields are now about 20 basis points off the absolute highs that they reached last week, and going through a little bit of a period of consolidation.
Aditya, what are expectations on how much further bond yields are likely to rise? And do we have a magic 10-year US bond yield number?
Well, we tend not to have point forecasts for bond yields. We tend to stick to our more medium-term valuation-based process. I guess what I would say is that valuations have definitely improved, and they've gone from bonds looking expensive on a historical basis to something closer to fair. Now, when we have these type of turning points in the economic cycle, it's very unlikely for an asset class to move from being rich and being expensive to being fair and then magically staying there. More often than not, you do get a little bit of a movement beyond fair into an overextension into cheapness. So we're certainly not pounding the table to add duration here, but certainly as a starting point now, valuations have improved. If you were to kind of push me for a potential range for US 10-year notes for the second half of this year, I think they'll end up somewhere between 1.5% and 1.8%.
Given the concern around rising rates and with inflation expectations increasing, how does Pimco position portfolios to take advantage of this?
Yeah, so even though market beta conditions have been challenging, The rise in volatility, the divergence in fiscal and monetary policy around the world between countries is presenting us with lots of opportunities to add value to our portfolios from an active management point of view and help buffer portfolio returns during this challenging beta environment. For Pimco portfolios, we've been positioned rather risk on since around the fourth quarter of last year. And we've done this by being short duration relative to our benchmarks. We've also had a yield curve steepening bias. So we implement this by being short long maturity bonds in the 10 to 30 year part of the curve, but be long in the short to intermediate part of the curve, somewhere between 3 and 5 years, and take advantage of this yield curve steepening move. We've also been positioned for tighter spreads, so across high-grade spread product like semis and supras, but also in corporate credit and RMBS. And lastly, we've had a short US dollar position in FX markets, which benefits in a broad economic recovery scenario. We've also had a small position in inflation-linked securities to help protect portfolios against rising inflation risks.
Thank you, Aditya, and thank you for joining us. If you have any further questions, please speak to your Pimco account manager.